Happy Thursday, Baby Friday, as some call it. Welcome to the Open here on BNN Bloomberg. Let's get to the big stories we're bringing you from our newsroom. Revenue and profit in the latest quarter at Rogers Communications topped estimates. The results were boosted by the company's sports empire. For example, that gained from the Blue Jays' playoff run. For the full year, Rogers is projecting revenue growth of between 3 and 5%. We're going to get more on those Rogers results soon from Bloomberg's Melissa Shin. Tesla shares up 2% in the pre-market. That company topped earnings and revenue estimates in its fourth quarter, but it wrapped up its first ever annual revenue decline as auto sales slowed amid rising competition. Full year revenue was down 3%, and net income plunged 61% in the quarter. Tesla is now leaning heavily into its bets on AI, robo-taxis, and humanoid robots to drive future growth. Revenue and profit in the latest quarter at Canadian Pacific Kansas City came in slightly below estimates. The rail company CEO says the ongoing tariff war cost the company $200 million US over the past year. However, the company's boss also says the railroad was able to control costs as it faced macroeconomic and trade policy headwinds. And it looks like we are going to get the S&P 500 opening in record territory this morning after a whole bunch of tech earnings exceeded estimates. Let's see how the TSX closed yesterday. It hit a new record high. And moving on to oil. Let's see how that's faring as the world wonders, will U.S. President Donald Trump go for attacks on Iran, possibly jeopardizing supply from the Middle East? Look at the run oil has had, almost $66 right now. And gold, that's had a run itself, and that is trading in record territory as well, up around 4%. Let's check out the Canadian dollar. And we've seen this week US dollar pushing up our currency. Not great for Canadian exporters. And finally, let's have a look at Bitcoin, the world's biggest crypto, slipping once again, stuck barely above 87,000 US. Lots to chew on this morning. Tech heavyweights Meta, Microsoft, and Tesla reporting results and profit topping expectations. But gold, of course, in record territory again, nearing $5,600 US for the yellow metal, and silver hitting its own record highs. Let's get perspective from Lyle Stein, president of Forvest Global Wealth Management. Lyle, great to see you. Can we start off with gold? I mean, that is in a way an alarming sign, isn't it, that people are retreating to this asset?
Well, you know, it is a sign that people want a security blanket. They're looking for some protection from all the geopolitical concerns, all the potential inflation concerns, a whole bunch of reasons. But it goes even beyond gold in some respects, Andy, because you're looking at big moves in other commodities. Mm-hmm. Silver, you mentioned. And as you go down the list, copper, and even the last week, we've had oil run. You know, these are all hard assets. And from a portfolio manager question, it's interesting. What do you do with all these hard assets?
What do you mean? What do you do with them? How do you play them?
Exactly. So, I mean, look at pick a chart. It doesn't really matter which one, but we might as well go with gold because that's 54.50 or whatever it is today. The stock has gone what we refer to as parabolic. Mm-hmm. It just looks like that old hockey stick, right? Where it's got a short shaft and then a long staff.
Yes.
It's interesting. But how do you play this? What do you do in the context of a portfolio with gold stocks, but with commodity stocks, hard asset stocks in general? And it's a big question. Now, as you know, we've held gold in our client portfolios for a long time. It's been a wonderful place to have been. But today, at current gold prices, what do we do in our portfolios? And, we believe gold has two roles. It's got an insurance component, and then it's got sort of a investment, call it momentum mode. That's more the stocks as opposed to the insurance is the hard bullion asset. And so in our client portfolios, what we're actually doing is taking some of the wonderful gains that we've made in our gold stocks and moving it more into the insurance component. And so, when we think of gold positions, roughly we're 10% in the gold commodity, the insurance, and 15% in the stocks, where we had been shifted much more towards the stocks over the course of the last 2.5 years.
That's interesting. So, sorry, just make sure I had that clear. You still have a good weighting in gold, the metal, but you're moving into the stocks. So you're overweighting the stocks right now, relatively speaking?
Other way. So we had been much more exposed to the stocks because of the leverage you get from the operating businesses. But now with gold running the way it's been running, we're leaning more to how do we get more insurance into the portfolio? So let's own the bullion directly.
Right. Copper is on fire as well. And apparently a lot of that is speculative activity in China. Copper topping $14,000 US a ton for the first time and surging in US trading as well, as we can see, up 10%.
Yeah, and we see that as a result of two factors. Number one, the world's central bankers, the world's politicians are doing what's called running the economy hot. They're putting fiscal stimulus in, and they're trying to keep interest rates low. And so you've got this whole demand side into a world of copper mining where there just isn't mining capacity to meet the demands for AI needs, for electrification needs through the entire grid. And so what happens is the commodity stock goes up. I mean, I can't explain the kind of moves that goes from 6 to 653, essentially overnight. But the basic copper story is that it's in long-term deficit supply. So prices will have a bias to go up in that environment.
Yeah, Bloomberg is saying today that copper is being fueled by intense speculative trading in China and people who have no interest really in copper as a metal piling in because they see momentum here.
And I'm not going to cast judgment, but silver is kind of in that same camp too.
Right.
It's an industrial metal. It benefits from economic activity, but there just isn't enough physical silver to meet the needs of the speculators when they're in the market transacting every day. And so what happens, you get these parabolic moves. And the question is, it's wonderful to ride on the upside, but we all know what happens on the downside, and it tends to fall quite quickly as well.
It looks as though the tech earnings, broadly speaking, were pretty good.
Yeah, well, it depends on the company, right?
Right.
We had Meta on the upside,
yeah,
but the big one is Microsoft, which markets weren't too happy about. Now, we own neither of them, but we were looking for in those numbers is what are they saying about CapEx? Because the whole AI CapEx spending boom has been driving not just the stocks, but the U.S. economy. They say half the growth is coming from AI spending. And Meta, which was in the doghouse not too long ago because they were going to spend more than the anticipated revenues, is now going to continue the spend, but everybody's happy because they had revenue growth. On the other side, on Microsoft, you didn't see the growth that people were looking for in their cloud business, and they didn't like that. So, the world is changing there, and it is becoming much more, I think, and this is perfectly indicative of what we refer to as a stock picker's market. We own Amazon, Google, and Micron. We're looking at these names carefully in the context of what Amazon and Microsoft are saying with respect to CapEx, because it impacts everybody.
It looks an interesting. I'm actually looking at the story on this Microsoft in the Economic Times of India. They highlight something that apparently new disclosure revealed that OpenAI accounts for 45% of Microsoft's backlog of 625 million. I presume a lot of that is cloud business, but that's interesting that you're so exposed to a company, OpenAI, whose debt is raising eyebrows among investors.
Well, and that's a big question for the whole sector, is how much debt is being taken in. And in particular, in the case of Meta, Meta is doing the financing of a lot of their development of AI centers off the traditional Meta balance sheet. It's off the books kind of thing. And there are questions as to how willing the lenders will be to continue to provide the kind of capital that Meta needs. I mean, you look at Meta's forecast of $115 billion. Just last night, I looked up how much Canada as a country spends on that kind of spending. And in 2023, I think we were at maybe $350 billion Canadian. I mean, Meta is half of that for all practical purposes. It's quite amazing how much money is actually being spent. And, if they build it, will they come? We've all seen the movie.
Yeah, Meta. So they're now forecasting their CapEx will jump, my goodness, this year. I believe it's this year. Yeah, a CapEx of up to $135 billion at the top end, almost twice last year.
It's a massive number. And that's just Meta. I mean, then you throw in Google, you throw in Amazon, you throw in Microsoft. Microsoft, I think, said they're going to spend about $35 billion. Don't quote me on that. But, I mean, these are massive numbers.
Yeah. It's interesting. Just one, this is a bit off topic with Meta, but we keep hearing about these ads running on Instagram, not just Instagram, other platforms, but in this case, Instagram, fake ads. And Meta doesn't seem to be able to stop that if they are interested in doing it.
Interesting. Well, I guess if they're fake and they bring in money, I mean, look, there's a whole bunch of questions that are involved in there. But the big issue is that real money? Go back to the movie. They're building it, but what will the revenue be when, in fact, they come? And then the business models are changing at the same time. Data centers are very capital intensive. And, Meta, Facebook was a software company when it first started. The margins for capital intensive businesses are much higher, but the cost of capital is a big component, and depreciation expenses going forward are huge numbers.
That's interesting. Yeah, they're far less virtual companies than they used to be. Yeah, they're going to have these huge and stuff depreciates. I know the industry says, well, we can use the chips for other stuff, but this stuff does lose its relevance pretty quickly.
It is interesting. And Andy, I'm kind of thinking about, so the Bitcoin miners, what's the difference between a Bitcoin miner and a copper miner? I mean, you got to spend a lot of money, and how long do you get of an asset life once the capital is employed? And in the context of AI chips, where all the money seems to be going, they have short lives. Gold mines, a good gold mine's got a 30-year mine life.
Lyle, thank you very much indeed. Lyle Stein, president of Forbes Global Wealth Management. Coming up, a sticker shock at the supermarket. New polling indicates that groceries remain the biggest driver of cost of living concerns for Canadians. Canadians continue to struggle with the cost of living. Two polls are offering a glimpse into post-holiday spending habits and pain points for consumers. New Nanos numbers indicate that the primary financial concern for Canadians right now is groceries. And many people are pulling back this January after feeling like they overspent during the holiday. Let's get more from CTV's Scott Hurst. Scott, give us the outline of these numbers, please.
Good morning, Andrew. Affordability remains a top concern, even though we have seen the inflation rate has stabilized somewhat. But one area that has stood out is that food prices have consistently risen faster than many other goods. So sticker shock at the grocery store continues to be a top concern as Canadians are looking to find ways to save in 2026 and find ways to cut back this year. So a just released Nanos CTV News survey provides a snapshot on affordability concerns, and those food prices remain the top financial burden, and Canadians are saying cutting grocery costs outweighs concerns about any other major financial issues such as housing or healthcare costs. And it doesn't matter if you break it down by region, age, or gender. Every demographic cited, grocery costs is the area they'd like to see costs reduced this year and prices come down, as of course we can't skip going to the grocery store, having to buy food for ourselves or our family. So it really is a burden on so many families, and we've seen this in recent years. Millions more are struggling to afford food, and many more in those past couple of years have turned to food banks just to provide enough food for themselves and families as well, Andrew.
What are Canadians doing to actually cut these costs?
Yeah, one thing that we're looking at, that we're seeing at these surveys, according to Canadians, there is a 2025 financial hangover as we're looking in 2026 to find ways to save and cut costs. There is still a hangover from all that holiday shopping. And according to a new report from financial technology company Coho, a third of Canadian holiday shoppers say they went over budget. So now as January hits and we get those credit card bills from the previous month and we see that we may have gone over budget, we're all looking for ways to cut back and save. And according to the survey, one of the top places Canadians are looking to stop right now or cut back right now or ultimately going out for less meals. And so relying more on those grocery costs and those grocery prices. But the top area that Canadians are looking to cut back to get themselves back to normal spending would be many Canadians say that they're going to try to go out less, at least to start the year, to try to save some money, Andrew.
I'm always saying this, but it would be great to see Aldi, the European deep discounter, come into Canada. They are in America, and they do force other grocers to sharpen their pencils. They have loads of generic products, but I remember being in one in Spain. There was beautiful gazpacho and cheese, but okay, we can but dream.
Well, deep discounts is what Canadians are looking for right now.
That's right. Scott, thank you very much indeed.
Thanks, Andrew.
Scott Hurst of CTV News. Okay, Rogers getting a profit boost from the Blue Jays, even though their failure to win the World Series was a heartbreaker. We'll be right back. Revenue and profit in the latest quarter at Rogers Communications topped estimates. The results were helped by the company's massive investment in sports. Let's get a bit more from Toronto Bloomberg, Toronto Bureau Chief Melissa Shin. Melissa, thanks very much indeed for joining us. According to TD, the wireless and cable numbers were in line, but the beat came from sports and media.
Yeah, that's right. Rogers did better than expected. They reported adjusted earnings of $1.51 per share, which is 7% more than the $1.42 that a survey of Bloomberg analysts were expecting. And as you mentioned, this was mostly driven by the media segment. Rogers doubled its stake in MLSE, Maple Leaf Sports and Entertainment, as of July 1st. Last year, and so that showed up in the earnings for Q4. And as you mentioned, and slightly re-traumatized me, the Blue Jays made it back to the World Series, but did not win. But nonetheless, that did create quite a bit of revenue. And so media revenue actually grew 126% year over year, hitting $1.2 billion for the quarter. And that's also notable in part because last Q4 2024, that was when Taylor Swift came to Toronto and Vancouver, and that didn't happen this year. And so, they did have the Blue Jays run that sort of offset that.
And you were listening into the conference call. One thing they mentioned was discounting by competitors.
Yes, that's right. Sort of around that Black Friday period in Q4, noticed that quite a few of their competitors were doing discounts, and Rogers seems to be more focused on a value-added strategy. And so one example is this satellite to mobile service that they're now offering, and they were saying that they're trying to go for users that traditionally haven't had the best network coverage, and sort of saying, hey, this is a benefit for you. And they're also offering it for free on some of their plans right now, which is kind of a way to get people interested and in. So they're not doing as much discounting as their peers.
It's interesting, though. Average revenue per user on the wireless side was down. It was down just over 2%. TD says that was actually a little better than they expected. But that followed a decline of just over 3% in Q3. So it does look as though bills, or at least the amount people are spending, are shrinking.
Yes, and the immigration changes policy-wise here in Canada have really affected all of the wireless. Having newcomers come is what really, in many cases does drive growth. And because that's not happening, they're really just hoping for greater penetration into existing. And they also, of course, noted that Q1, which is coming up, which is now, tends to be a difficult quarter for new growth in wireless. So they're just sort of reminding people of that.
Anything else on the call about their plans longer term for sports?
Yes, so they did reiterate their long-stated plan to buy the rest of MLSE. So right now, as mentioned, they own 75%, and there's another 25% that they hope to own, and they can exercise the option to do that as of July. And so they, reiterated the plans that they're continuing to be on track, and they feel that the quarter that they had and the year that they had does set them up well for that.
It's interesting how addicted we are to these wireless devices. I left my phone at work yesterday. I realized on the subway, and it was a horrible feeling. And then I got home, and my wife said, it's at work. But I learned that she can track me, of course, using Find My iPhone. So there was a couple of learnings for me yesterday. Anyway, Melissa, thank you very much indeed.
My pleasure.
Melissa Shin of Bloomberg. Coming up, we're going to check out U.S. futures and gold and oil as we await the opening bells. Oh, I'm sorry. Yeah, let's do that right now. No time like the present. So it looks as though the S&P 500 is going to open in record territory right now, north of 7,000. And of course, stocks boosted by some tech earnings that pleased investors. Microsoft under a bit of pressure. I think that is interesting, that apparent heavy dependence on business from OpenAI with its questionable balance sheet. But Meta stock investors happy. Look at the sell-off there in Microsoft. Maybe we could have another quick look at Meta Platforms, the gigantic company. Revenue outlook, analysts think, supports the massive spending on AI and the ad business picking up. But of course, they are putting a lot of money into artificial intelligence investments. Another look at gold, and let me just check the spot price of gold. And I wonder if we should try to get on one of these. We'll buy your gold for cash, people, because I wonder, are they getting a lot of people coming in with old unwanted jewelry? I have tons of that lying around the house. Okay, we're going to be right back with the opening bells. And there are the opening bells at the NASDAQ. And New York and Toronto. At the NASDAQ, PicPay is a Brazilian fintech company, just went public, controlled by Brazil's Batista family. At the New York Stock Exchange, York Space Systems also going public, and they are involved in spacecraft that have been pitched as part of the Golden Dome missile defense system in the United States. And at the TSX, it's Lunar Royalties celebrating its new listing on the TSX Venture Exchange. It's time for the first 50. And let's check out the North American benchmarks first to see, are we in new record territory? And sure enough, we are. The TSX moving higher, yet another jump in gold prices helping that. And also we've seen this sharp rally once again in oil. Oil moving up rapidly towards the $66 level. Now, some of that is a weak US dollar, which this week hit its weakest in about 4 years against world currencies, especially euro. And the spot price of gold now comfortably north of $5,500. Some stocks of interest in early trading. Let's have a look at Rogers. Melissa Shin of Bloomberg told us about the beat there, fueled by sports. Interesting to hear, though, that average revenue per user dropping in the latest quarter, following on a drop in the previous quarter. And let's have a quick look at CP Kansas City. TD reckons that there was strong cost control in the latest quarter, the stock edging up about 1%, but it's been under pressure over the past year amid worries over cross-border trade. And let's have a look at Empire Company, because that company is taking a write-down of $750 million on e-commerce. It looks as though they just are not seeing the traction for grocery delivery that they'd hoped. TD again says consumers are now looking for delivery in hours, not days. But apparently this is mostly non-cash, and so investors don't seem too worried. And what else? Let's have a very quick look, at CLS, Celestica here, because they came out with their EPS guidance for this year, and they're raising it to $8.75 from $8.20, although the stock slipping, but they too are talking about a massive jump in capex. Let's check out some movers south of the border. We are joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Give us a bit more color on Microsoft, if you would, Jeff, please.
Yeah, Microsoft is one of the worst performing stocks in the S&P 500 this morning. And if we were to quantify the move lower, which is about 10% right now, that is the equivalent to the to $353 billion in market capitalization disappearing for this company this morning. So what has happened? They reported results overnight, and the results were a little bit underwhelming. The expectations were very high for this stock coming into the quarter. Of course, Microsoft is one of these AI and AI-related names where expectations were just through the roof. This morning, as a result, we've had Bear cut the price target on the stock. We've had Barclays cut the price target on the stock. And we've had just a general kind of underwhelming narrative. They came out with expectations that they were going to spend a little bit more than expected, while their cloud computing business was a little bit weaker than expected. So if you put all of these things together, the stock is maybe under a little bit of pressure this morning, just because expectations were so high. Spending is also very, very high. $56 billion is the expectation for the build out here.
Meta, though, investors like to look at those numbers.
Yeah, it's kind of a case of winners and losers in the big cap, mega cap tech space this morning. Meta is one of the top performing stocks so far. It's up 9% right now. Now, Meta is a smaller market cap than Microsoft. If you put those numbers together, this is about a $165 billion addition to its market cap. But what you have here is you have the revenue outlook for this company growing at the same time as the capital expenditures for the AI build out growing. So JP Morgan, Morgan Stanley, Stifel, Truist Securities, all coming out raising their price targets on this stock this morning. The numbers in this case are just completely kind of eye-boggling. Capital expenditures for this year for Meta, $115 billion to $135 billion. The street had only expected $110 billion, but I guess they're allowed to spend that much when the revenues are growing. Companies seeing $53 to $56 billion in revenues for the first quarter. Wall Street only expected $51 billion. So I guess they get a pass on spending up to $135 billion this year, as long as the revenues are growing.
Jeff, thank you very much indeed.
Thank you.
Jeff Morgan of Bloomberg. We're going to take a break. After this, U.S. President Donald Trump says he's frustrated by the high level of U.S. interest rates. The Fed did nothing on borrowing costs yesterday. Was that the right move? U.S. President Donald Trump in Davos asked a rhetorical question. He says, why is the yield on U.S. debt so much higher than other countries? For example, on 10-year, the American government is still paying more north of 4%, whereas Japan pays about 2.5%. and China less than 2%. David Malpass, former Treasury Secretary, says in the Wall Street Journal, one of the reasons is that the Fed is still leaving rates too high. Let's get a little bit more on this from Chad Owl, Chief Investment Officer and Head of Multi-Asset Solutions at SLGI Asset Management. Chad, I know we're venturing into politics here, but is there a case to be made that the Fed should be cutting more aggressively?
I mean, at this point in time, there is the Fed has a little bit of time, right? So and I think that was the main message that we took away yesterday from the meeting this was very much a textbook neutral pause for now, right? So the main concerns in the prior couple of meetings had been around the labor market, and it looks like the jobless rate from the most recent data has maybe arrested that upward climb for now. So they can wait and see. Look at the data. The economy still appears relatively strong. Inflation, is still a bit of a question mark. Probably at the higher end of an acceptable range. So it makes sense for them to pause at this point in time. And the market is looking kind of past Chair Powell's, the end of his term, and still expecting some rate cuts to come in the latter half of this year.
I should have actually said David Malpass was Undersecretary of the Treasury under President Trump and has been a Trump advisor, also worked for Ronald Reagan and George H.W. Bush. How are you playing bonds right now? Are you interested in U.S. or Canadian bonds right now, say, with a time horizon of 5 years?
Yeah, no, we have core allocations kind of globally diversified, but the U.S. and Canada make up a good chunk of that core allocation to bonds. And how we think about bonds in our kind of base case for this year, and U.S. bonds in particular kind of drive that point home in terms of, pretty high yields still. So it's still a very good income play. Certainly, if you look past the prior 5 years, you were not so used to deriving that sort of income. So within the portfolio in a base case, think about that high quality bond allocation as primarily a yield play. So you're still getting some pretty good yield. But the fact that yields are higher means that if our base case of a strong economy does not play out and you begin to see more deterioration, unexpected downside risk, there's a lot of room for yields to fall, which means capital appreciation on that bond portfolio. So you're going to get that portfolio insurance against the riskier assets that you have in the portfolio. So bonds are still a very important strategic holding. Think about the income, but also understand that you can get some insurance because the income is so high. There's room for the yields to fall and get that price appreciation if the economy begins to derail.
You think the big takeaway in tech earnings right now, especially looking at stocks like Meta and Microsoft right now, is the market will tolerate you spending heavily on AI, but you must be beginning to show rewards for that?
Yeah, absolutely. One of our main themes for this year was that, AI, that theme is not going away. We think that's a multi-year kind of beyond the cycle sort of theme. But this year, the focus is definitely going to move more towards what's the return on investment for AI. And we're already seeing that in this first batch of results. So, the market will be a little discerning around, we're seeing some huge amounts of capex on the AI theme, and the hyperscalers are out there spending, certainly planning to spend even more than last year. But as long as the sales and the top line is growing, exceeding expectations, the market will tolerate that, will even cheer that. And we're already seeing that from Meta, for example. Microsoft on the flip side, again, is planning to grow spending, not keeping pace on the sales side. The stock is being punished. So I think the market will discern between those that are deriving that return on investment for their AI investments. And I think that's actually a good thing for the theme, particularly for those that are concerned that we're entering bubble territory here on the AI theme. The fact that the market is picking its spots and is holding, at least a certain amount, holding these companies to task in terms of, are they still delivering growth at the top line? I think it's actually a good thing in terms of the durability of this theme. And we're expecting to see more differentiation. Again, like I said, who's delivering the return on investment, the ROI for that AI?
And just finally, what are your thoughts on small caps? I'm just looking at the Russell 2000 right now. It's near record highs, but over the past week or so, we have seen the small caps lagging the big names a bit.
Yeah, so the first couple of weeks of the year, certainly there was a broadening out that we saw in the size space, smaller cap companies playing a nice amount of catch up versus their large cap cousins, of course, the very tech heavy large cap. And I think that was reflecting the fact that, like we talked about with the Fed announcement yesterday, that the economy is still looking relatively strong, maybe exceeding expectations to a certain degree. So Main Street beginning to play along a little bit more with what's going on with those large cap tech stocks. So you saw that catch up on the small cap side. You saw rotation even trade from a sector perspective, where you saw greater participation, certainly resources, which have been a huge story so far this year, but even consumer staples, industrials have been outpacing the broader market. But then again, in the last week or so, those large caps have really had a great run. And I think as these earnings that we talked about have come into focus more so, it just is a reminder that while there's a broadening out, and I think it's very healthy for the market. That AI theme around those mega cap stocks, it's not going away. It's going to be a major theme for this year.
Chad, thank you very much indeed. Chad Owl,
thank you.
Chief Investment Officer and Head of Multi-Asset Solutions at SLGI Asset Management. Coming up, after accepting an unprecedented pay package from Tesla shareholders last year, we'll look to see if Elon Musk has actually lived up to his end of the bargain. Okay, let's drill into Tesla's earnings. Let's have a look at the stock. The company did post an earnings beat for its fourth quarter. You can see the shares up around 1%, and it is going to discontinue its Model S and X vehicles and invest $2 billion US in Elon Musk's artificial intelligence startup, XAI. Let's get more from Itai McKelly, who is equity analyst at TD Securities. Thank you very much indeed for joining us.
Thanks for having me.
What jumped out for you with these Tesla numbers? Start with the profit, if you would.
Sure. I think the number one takeaway is that Tesla delivered a resilient quarter in the midst of challenging EV fundamentals, both in the U.S. post the expiration of the tax credits and just a globally competitive market, particularly in China. The automotive gross margin, excluding credits, did expand by a couple hundred basis points sequentially. This marks now the third quarter in a row where Tesla's gross margins have been recovering. So overall, we thought it was actually a pretty good quarter and comfortably ahead of consensus. And that kind of helps set the foundation for the company, for sentiment around the company to improve as Tesla enters a period with potentially significant catalysts on the autonomous and robotic side.
So they're dropping their two oldest vehicles, the Model S sedan and the Model X SUV. But do they have enough new product to make up for that?
They do. The Model 3 and Model Y, a substantial portion of the volume today. The S and X, certainly kind of the original vehicles that drew Tesla's brand and success, are now a very small part of the overall volume. And they're going to, of course, repurpose that capacity. But increasingly this year, we do think autonomy will become a central role, frankly, for driving Tesla's vehicle demand. Oftentimes people talk about the autonomy separate from the EV side of the business, but ultimately they will be, in our view, very much interlinked, just given all the various features the company should be able to launch once they go to fully unsupervised FSD, and of course, eventually integrating those vehicles with the robo-taxi fleet as well. So we think going forward, the autonomy will become not only an incremental source of revenue and profit growth for the company, but also potentially a major driver of demand going forward.
So you have a buy rating on Tesla. What is the main thing that you think will drive the stock higher?
Sure. For us, a lot of it comes down to some significant catalysts in unlocking major opportunities within vehicle autonomy and robotics. You think about people. You think about Tesla as a car company, tend to think about their addressable market as selling new vehicles. But the real addressable market, in our view, is a lifetime revenue of vehicle generate and then incremental services even on top of that. In the U.S. alone, that's a $1.5 trillion market, and we think autonomy could help Tesla unlock major portions of this. And this is no longer like, many years out. The company did outline about 7 cities that will be launching just in the first half of this year alone for robo-taxi, and eventually we think unsupervised FSD will be integral to driving additional services and expanding all that revenue pool, alongside, of course, the robotics investments that they're making. And as I mentioned before, that should also drive higher EV demand. So we don't think the company is completely shifting to a whole different business model. We think selling vehicles will remain important, but that really drives our thesis, just given that we are in the here and now of some of these catalysts in the next few to several months.
Now, you may have touched on this, and I'm sorry if you did. Optimus, their humanoid robot project, is that a serious investment for the company? Are they putting big capital into it?
Absolutely. A lot of opportunity there. You're seeing a lot of companies also invest in that. So it is really forming into a sizable industry. It still is in the R&D phase, as Tesla mentioned on the call last night. They will be unveiling their kind of version 3 in the next few months. So we will get additional data points and momentum around Optimus. But the growth is still a couple more years away. But that is a significant opportunity. So if you think about this year as sort of the year more for robotaxi autonomy with some kind of incremental growth and development for Optimus. Next year and the year thereafter, Optimus, we think, can start to become a much bigger portion of that revenue growth equation. But it is equally an exciting opportunity as well for the company.
What about the fact, though, that China's electric vehicles are sweeping the world? Now, I know Musk makes cars in China, but are the likes of BYD and Chery a major challenge for him in autos?
Yeah, the Chinese market is very competitive. There's some really great product out there. Now, Tesla does not compete in every single price point, but even in the price points and segments they compete, there is heightened competition. And that's kind of what makes the Q4 margin beat so much more impressive, right? Because not only was there the headwind in China from a competitive perspective, as you bring up, but also the U.S. EV demand was more depressed given the pre-buy we saw in the third quarter ahead of the IRA expiration. So to see the gross margin expand despite lower sequential deliveries, I think kind of puts more ease at some of the concerns around how Tesla would manage this more challenging time in the industry. And if those challenges go away tomorrow, but kind of off a higher earnings base than previously expected, that does provide, again, the foundation for sentiment to improve as now kind of the AV and robotics catalysts really come into view.
Itai, thank you very much indeed. Itai McKelly, equity analyst at TD Securities. Coming up, we're going to head to Ottawa to get the latest on the First Minister's meeting, which is underway. And Trump and trade are expected to top the agenda, or at least come near the main topics. The Prime Minister and the Premiers are gathered in Ottawa for a First Minister's meeting. Let's get more from CTV's Annie Bergeron-Oliver. Annie, thanks for giving us the time. This is the first meeting between Mr. Carney and the provincial leaders this year. What's going to be on the agenda?
Good morning, Andrew. Well, it's a busy day for the Prime Minister and the 13 premiers of the provinces and territories. There's a lot on this agenda. The Prime Minister gave an opening speech today where he talked about the major projects, the need for Canada to become more self-reliant, a much stronger economy by being less reliant on other countries. He talked about trade, how Canada intends to do new trade arrangements with countries like India and the ASEAN nations in the coming weeks. And he said, this will be an opportunity to talk to the premiers about their priorities for trade, what they think about these deals, how they can work together to get these trade deals done, and also how to increase imports into Canada from some of these countries without hurting domestic production and domestic industries. Obviously, the CUSMA negotiations are going to come up, and the Prime Minister mentioned that as well in his opening remarks. Yesterday, you heard a little bit of trepidation, if you will, or some concern about this upcoming negotiation. The provinces and territories obviously have a lot at stake here for these renegotiations that are expected to start with the United States in the summer. And what you're really seeing, though, Andrew, here is all of the premiers saying that this is a Team Canada approach, that they're looking for collaboration in these meetings. They're looking to provide sort of conversations that put Canada at the forefront to ensure that this is a Team Canada united approach. Even though there may be discussions that are tough, ultimately the premiers all say that they really want to collaborate and show a Team Canada approach coming out of these meetings.
Of course, they do all join hands, don't they? But there are always going to be conflicts, aren't they? Western Canada, very dependent on resource exports. We in Central Canada still have something of an auto industry left.
That's right. And you know what? One of the big areas of sort of disagreement, if you will, that's kind of overshadowing this a little bit is the talk of separatism for both Alberta and Quebec. You know, Premier Legault, the Quebec premier, this is most likely his last First Minister's meeting. He said he's going to step down as soon as his party finds a new leader. Right now in Quebec, the PQ is leading. And so a lot of the leaders have been asked, well, what happens if at the next meeting it's a separatist who's sitting at this table as the Premier of Quebec? And the leaders are all saying, look, right now this is not a time to bring instability into the Canadian economy. They say we have enough challenges ahead with the United States and Canada needs to stick together. You heard Premier Houston of Nova Scotia saying that he likes Canada the way it is and nothing should change. Premier Ford as well said it would be a disaster if Alberta were to separate and was calling people in Quebec to stay and to not even have this discussion. So while the premiers are trying to really portray this aspect of unity and talking about a Team Canada approach, there are definitely undercurrents here about the breaking potentially of unity in Canada, given there are talks of separation in Alberta and also in Quebec.
Thank you very much, Annie. Annie Bergeron-Oliver, our colleague at CTV News. We'll be right back. Welcome to the second hour of The Open. Let's check out the big stories we're bringing you from our newsroom. Shares in Rogers Communications up about 3% after revenue and profit in the latest quarter topped Bay Street estimates. Results were boosted by the telecom's massive holdings in Canadian sports. It benefited, for example, from the Blue Jays' playoff run. For the full year, Rogers is projecting revenue growth of up to 5%. Celestica shares sliding 12%. Analysts are highlighting the company's increased capital spending, as well as what some think is a disappointing full-year outlook. Celestica is boosting planned capex to $1 billion for the year. On the upside, revenue and profit in the fourth quarter beat expectations, and there was an increase in sales driven by continued demand for AI data center technologies. Shares in Lockheed Martin jumping 7% after the company provided a full-year forecast that beat estimates on both revenue and profit. This outlook comes after the defense giant signed a 7-year deal with the U.S. Department of War to provide more missile interceptors. The company's CEO says 2025 saw unprecedented demand that is already being seen in 2026. And the TSX slipping slightly in early trading despite fresh strength in gold. Just looking at the big traders by value here in Toronto. Royal Bank of Canada is higher, but Celestica is helping to drag down the market. And we're also seeing a bit of selling in a couple of the golds. Agnico Eagle down more than $5. Kinross also dropping. And Cameco down a bit as well, down more than $5. And let's have a look at the U.S. market, because that has been hitting record highs, or it did yesterday. However, losing a bit of altitude in the latest results or the latest trading, the stock market being dragged down in part south of the border by that weakness in Microsoft. Let's get more on today's trading, especially in stocks that announce quarterly results and forecasts. We'll start off with Celestica. We're joined now by Diana Avigdor, VP, Portfolio Manager and Head of Trading at Barometer Capital Management. Diana, thank you very much indeed for joining us. Start off, if you would, with Celestica. That stock under pressure right now.
Good morning, Andy. Thanks for having me. It's very timely. You're catching me and Barometer at Decision in Motion because the Celestica earnings were pretty good. And to see it trade down this much is a little bit of a head scratcher. So after the earnings, it traded down 6%. And actually, right before the open, it was only down about 1%. Now it's sliding quite hard. So Celestica, of course, builds networking and AI infrastructure hardware used by the hyperscalers. And what we've seen from Meta and Microsoft and all the others, well, we haven't seen Google yet, but this is a major growth engine that plays into data center CapEx, and CapEx is increasing. Celestica has a connectivity and cloud solution business, which grew 64% year over year. Earnings were good. They beat expectations. Operating margins were good, driven by good margins. Revenue was all beat. So yes, they increased their CapEx by about $1 billion, which will be funded from cash flow, from operating cash flow. So that's okay. Stock should have been okay, but I guess it did rally into numbers. 12%, I think, is overdone. If the next question is, should you buy it here?
Yep.
Our strategy is to stay away when there's days like this. You want to see it settle. And if it continues going down, our strategy is we will find a technical level where if it breaks, we will stay out of the way if it continues to act in a way that we don't understand.
That's interesting. You said it was down quite modestly in the pre-market, but then once trading started, it took a hit.
Yeah. It was down about 1% pre-open. After the earnings, it did go down about 6% and traded down there. And then as the morning progressed, and people were talking on the trading desk about the earnings, there was nothing in the earnings that should warrant 12% or 13% sell-off. And our strategy at Barometer is price has to reflect what the narrative seems to be. And if there is a disconnect, we will find a technical level where we would, from a discipline and risk management point of view, we will find a place where we will put ourselves in a stop loss situation. It could be another $20, $30 below here, but we won't stand in the way down $65, not knowing or not understanding why it's acting this way and why it's so extreme.
Move on to Meta, if you would. CapEx is a highly watched metric there as well. That stock, though, up in early trading.
Seriously, it has reported really great quarter. I heard you before where you said that, CapEx spending and all this AI build, people want to see profitability or some kind of visibility into how this translates into profits. And that's what Meta did. What Meta did was reported a very good quarter, and expenses were announced to be much higher than expected. Total expenses up to $169 billion, with $115 to $135 billion of it in CapEx. But the stock is trading up because it also reported a higher than expected guide on the earnings before interest and taxes line, which we called EBIT. The fact that they're guiding earnings up, despite the higher than expected expenses, emboldens investors and kind of closes the circle on this investment spending versus profitability and return conversation.
Do you think investors are being too hard on... before I get on to Microsoft, Diana, would you be a buyer of Meta right now?
We don't own Meta. We would have to take a look at it. Look, there is also another trade going on in the market, and that is this broadening and this commodity preference. Stocks act the way they do because you don't have to be in everything, and you can't be in everything. So maybe investors are finding growth and value elsewhere. So money is flowing into the commodity patch in all kinds of reasonings, and whether it's geopolitical or earnings coming up. So the answer to your question, would you buy Microsoft here? We don't buy the stocks that are trading down until we see that they have stabilized. Software has acted pretty poorly year to date. It is a source of funds. And until that changes, we would like to see that change and the price reflect better narrative.
Yeah, it's interesting. I noticed that CSU, Constellation Software, Thomson Reuters, all over the past week hitting their lowest price in at least a year. Some of these names are at multi-year lows.
Yeah. I mean, some of these names have received flows for years, and the commodity markets have not. Canada is part of Global, of course. So there's another cohort of stocks that are acting better than these technology stocks, notwithstanding what Meta is doing today. But Meta has been kind of uninspiring for a little while. It's acting well now, but we'll see if it holds.
What about Tesla? Would you be a buyer here? There are high hopes for these humanoid robots.
Seriously. So Tesla is trading on a developed imagination of what future revenue streams are going to come. The auto business did not do too well. Revenue, car sales, was nothing to see there. And actually, the stock traded up, and I think when I left the desk to come and speak to you, the stock was going into the red. I don't know if it's still trading down. I see by the chart on my screen now from you that it is.
Yeah.
So it did slide from being up after earnings to down. So yeah, it's trading on this imagination of its humanoid robot Optimus. CapEx, AI CapEx is fine. AI development is fine. How it's monetized, again, is what the next step here is, what people want to see. And to the extent that the imagination builds out that they're going to monetize it through robotics or other kind of AI, then that is what the stock is trading up on. Because skeptics always have said about Tesla that as a car company, its valuation is way higher than the other auto companies. So it's not just an auto company.
Thank you so much, Diana. Diana Victor of Barometer Capital Management. Okay, up next, we are going to take a look at that British company, Ocado, which is Sobeys' partner in grocery delivery in Canada. It's taking a blow here because Sobeys is axing a fulfillment center in Calgary. Looks like Albertans not that keen on having groceries delivered. We'll be right back. Empire, the big food delivery or big grocer, is shutting down a fulfillment center in Calgary after disappointing results in grocery delivery. And this is affecting the shares in British-based Ocado, which is a big player, Sobeys' partner, and also a big player in robotic-driven grocery deliveries. We're joined by our own Lindsay Biscaya. So the British company, there's disappointment here that Sobeys is shutting this Calgary facility.
Yes, there is. So just to give our viewers a little bit of background, first of all, we're talking about Voila, which I think a lot of people have seen or heard about. It's like another e-commerce delivery, grocery delivery business that Sobeys owns. And so one of these warehouses in Calgary was delivering, goods, like packaging them there and then sending them out. And now we know that Empire, the parent company of Sobeys, is canceling the services at that warehouse warehouse basically shutting it down. Also another small warehouse in Edmonton. And there was another one being built in Vancouver that now that is paused and is not going to be built anymore because the company is saying they're just not seeing that demand for online delivery of groceries in Alberta the way they are here, for example, because Voila is going to continue in Ontario and in Quebec. Obviously, we're sitting in Toronto right now, which is why I say here. So yeah, Empire says it will be taking a $750 million write-down on the business, saying the results from this online grocery expansion just really weren't what they thought they were going to be. And yeah, so this is hurting another company as well, as you mentioned, a UK-based company.
Yeah, it's interesting. I see that Bloomberg said that this model that Ocado is selling based on robots is costly. And Kroger in south of the border, the big grocer, shut down 3 facilities as well.
Yes. So yeah, Ocado, an online grocer and retail tech specialist, you're right, they do. They use these robotics within these warehouses to kind of pack the groceries that were ordered and then have them sent off. So Ocado was working in partnership with Empire and Sobeys. Sobeys was actually its second biggest company that it was working with. It still is working with it in Ontario and Quebec. But shares of Ocado today on the London Stock Exchange down about 10% because of this news. And according to JP Morgan, though, the Sobeys closure will have limited financial impact on Ocado for anyone who might be invested in that company. JP Morgan saying it's seeing limited risk for future closures within the Sobeys e-commerce business because obviously things are still going well elsewhere. And Sobeys has some third partnerships with like DoorDash and Uber Eats that is going to continue as well.
I like going to the grocery store.
I do too. Well, it's interesting because this warehouse in Calgary was built in about 3 years ago. So within the COVID-19 pandemic kind of era.
Sure.
And it seems as though that for other companies as well, like Loblaws, for example, their e-commerce business was doing better during COVID than it is now. So it seems as though maybe more people didn't want to go out, obviously, to grocery stores during the pandemic. But now I like to pick my own stuff as well.
Yeah.
You know?
And you see bargains. And
And if you're picking fruit and vegetables, you want them the way you like them.
Exactly.
Yeah.
Yes. Thanks very much, Lindsay. Coming up, the ETF report, we're going to zero in on some products from BMO, including a broad commodity ETF. And that's topical with copper, for example, surging once again. Let's get to the ETF report. And of course, gold hitting new record highs today. Same for silver. We're joined by Bipan Rai, head of ETF Alternative Strategy at BMO Global Asset Management. Bipan, always great to see you. Thanks very much. Could we start off with this product, ZCOM? It's the BMO Broad Commodity ETF. You launched it, I believe, only in October of last year. It's always tricky. I mean, what commodity are you going to weight in any index or ETF? There's different philosophies, but certainly it has beaten the Bloomberg Commodity Index total return over that period, a return of about 15% since October.
Yeah, I mean, it's been a fantastic product, and our timing has been impeccable when it comes to launching this product. And given the way that commodities have moved over the past couple of months, I mean, this particular ETF does take advantage of the fact that when commodities move, they tend to move together, regardless of which one we're talking about or which subgroup we're talking about, whether they're metals, softs, or grains. And we're particularly proud of this particular ETF. It does track the Bloomberg Commodity Index itself as well, and it's one of the added ETFs, we could say, that we're excited about within our suite of commodity-focused strategies.
So I'm looking at the Bloomberg Commodity Index total return. What are the big... last time I looked at the Bloomberg Commodity Index, gold was a big weighting in there.
Right. And it continues to remain so, alongside some of the other precious metals exposures within it as well, including silver and the like. But there's also a decent exposure for energy, and that of course includes oil and natural gas, as well as other categories, including softs. And again, the fact that we are headed into this trade backdrop now that's going to be a lot more restrictive. I mean, we are seeing a lot of countries prioritize sourcing imports sooner as opposed to later. So this front loading of demand is really buttressing this moving commodities, and of course, that's beneficial for anybody that holds a product like the ZCOM.
You have another couple of products. Let's start up with ZGD, and this is a gold play. It's the BMO Equal Weight Global Gold Index. This, I'm assuming, would tend to emphasize big cap gold miners, ZGD.
Absolutely, yes. And that's been one of our best performing ETFs over the past year. In fact, since the end of 2024, that particular ETF is up close to 220%. Now, mind you, we took that snapshot in terms of returns a couple of days ago. And given the move that we've seen in gold, I mean, we'd probably need to refresh that a little bit more quickly. But, again, that in conjunction with another a minor equity-focused miner that we have also as part of our suite. That, of course, is the ZJG, which is the BMO Junior Gold miners. Both of those are exciting products for us, products that have done extremely well. And, of course, recently we've cut fees on both of them, moving from an annual management expense ratio of 55 basis points to 40 basis points. So, again, this is our way of saying that these particular ETFs are well-positioned on a go-forward basis. And we're still expecting some additional upside going forward.
Back here to January of 2021, because both of these have been around for at least 5 years, I believe. And certainly ZJD has done pretty well. Our total return, according to my Bloomberg screen, of almost 400%, about 382%, beating the TSX Global Gold Index. That's below 300%.
Yeah, absolutely. And again, that's to take advantage of the fact that the underlying exposure is still towards gold. But of course, the story on gold is well established by now. And also, the other component there is, of course, the beta play. And the Canadian market did extremely well in 2025. And that momentum so far is carried over into 2026. So again, you are getting that beta exposure to the TSX. And of course, when taken in conjunction with the move that we've seen in gold prices, I mean, this is a particular product that's set up, or at least positioned to perform extremely well into the start of this year.
And tell us about this product, Z. We're switching to more broad equity ETFs here. ZUQ, it's the MSCI USA High Quality.
Yes, absolutely. I mean, if we're looking at factor-based investing into 2026, and we're focusing on the United States specifically, I mean, quality is a factor that we continue to highlight in our discussions with clients as a factor that could outperform. Now, that's tied to several different views. The first one we could talk to is really about the state of the economy and the fact that maybe, yields could remain elevated for an extended period of time. In that sort of backdrop, to us, it makes sense that investors will focus on companies that have strong, robust balance sheets and a stable source of earnings, which typically does benefit quality as a factor. Certainly, I mean, if you compare quality to the large cap space going back a couple of decades, the average annual outperformance of quality relative to the S&P 500 is close to 2%. So again, we did have a down year for quality last year. We do think this is the year that quality could reassert itself in the U.S. market.
Right. Over 5 years, that one pretty well equal with the S&P 500 in Canadian dollar terms, according to my Bloomberg screen anyway. And then tell us about this last product. Of course, this might have been an issue when Nortel, the ill-fated Nortel, dominated our market years ago. But you have the Capped Composite Index ETF in Toronto, ZCN.
Yeah, absolutely. I mean, that's our core exposure to the Canadian market itself. And again, you get to participate indirectly via exposure or increased weighting when it comes to the materials sector. And of course, the rally in precious metals should benefit that particular sector in Canada. In conjunction, you do also get exposure to the energy and financial spaces as well. And, despite the fact that financials did extremely well last year, we're expecting similar momentum to follow through to this year as well. And if you want to talk about a particular subsector, of course, we got to talk about Canadian banks. We continue to remain optimistic there, not least because Canadian banks are flush with capital, and that opens the door potentially for either share buybacks or dividend increases, or even increasing loans if demand for loans picks up in the Canadian economy, as we expect that they will this year.
And the 5-year return on my screen showing pretty similar to the TSX, both of them about 120% total return over 5 years. Right. Just very quickly, Bipan, what's the maximum that ETF can hold in any one stock?
Right, it's a good question. So if we're talking about cap composite, obviously we're talking about a level at which the particular ETF will cap its holdings in terms of one particular stock price. Now, again, we do tend to look at that quite closely, and from memory, of course. I mean, I believe the last time I checked, it was close towards 5 to 10%, 5% for each stock within the index itself. Now, that is beneficial if we're talking about relative to the broader index, because from time to time, as we well know from the United States for the last couple of years, indexes can get extremely concentrated. And, the risk is if a couple of sectors hold or at least account for a substantial portion of the weighting, that could be a risk if those particular sectors underperform.
Thank you very much indeed, Bipan. Really appreciate it.
My pleasure, Andrew. Thank you.
Bipan Rai, head of ETF Alternative Strategy at BMO Global Asset Management. Coming up, we are going to take a closer look at the disappointment over Microsoft's earnings. That's ahead. Celestica is one of the biggest decliners on the TSX today. Analysts are pointing to the company's increased capital spending, as well as what some see as a disappointing full-year outlook. Celestica is boosting its planned capital investments to $1 billion for the year. Revenue and profit in the fourth quarter beat expectations, driven by continued demand for AI data center technologies. Shares in CP Kansas City edging higher today. The rail company posted higher overall revenue in its latest quarter, and it saw non-freight revenue surge 26%, beating estimates. However, CPKC says the ongoing tariff war costed $200 million US over the past year, but it has been able to control costs. Canadian grocery giant Empire will be shutting down a customer fulfillment center operation in Calgary. Analysts say the $750 million write-down that the company is booking highlights the fact that returns from grocery delivery have not been what the industry expected. The company's CEO says the decision made in Western Canada will ensure long-term growth and profit in e-commerce. And the broad markets are down right now. It looks like, for example, the sell-off in Microsoft worrying investors. But of course, both the TSX and the S&P 500 near record highs. Amazon has announced a big round of global job cuts. CTV's Andrew Johnson has more on whether AI is to blame.
Close to 5,000 people work at Vancouver's Amazon headquarters, jobs the city very much hopes to hold on to.
These are very important jobs, they're high paying, and we're very glad to have them in downtown Vancouver.
On the day Amazon announced 16,000 corporate positions are being cut, the company won't reveal how many Canadians could be affected. North America's second largest private employer has been aggressively cutting costs since the end of the COVID pandemic.
Public health emergency basically compelled a lot of people to be shopping online. And when things reopened, some of that shopping shifted back to traditional brick and mortar stores. And so we had a resizing of the online space for ordering and delivery.
The question on many minds, are these human jobs being lost to AI? Amazon's CEO said in June he anticipates generative AI will reduce Amazon's corporate workforce. But today, the company points to paring down staffing in the name of what it calls reducing layers and bureaucracy. Tech experts say AI is simply not improving as quickly as some expected.
It hasn't continued on that trajectory. A lot of the models have leveled off in terms of their abilities. If you interact with ChatGPT on a regular basis, you'll know that it's still just a little bit stupid, and it still makes some really dumb mistakes.
Experts say they do notice hiring may be slowing down for entry-level tech jobs where the work can now be performed by AI. But the fear human jobs are being cut on a mass scale to be replaced by machines is not the reality. Andrew Johnson, CTV News, Vancouver.
So the number I'm seeing here is that Amazon has about 1.5 million employees in and the United States. And Walmart's had about 2.1 million employees in the USA. Right, we're going to take a closer look at this sell-off in Microsoft. Of course, a lot of investors think it's a relatively stable way to play tech, but those shares under pressure today. Microsoft out of favor this morning. A lot of investors think, or seem to think, that sure, this is a fairly stable tech stock. They've got a lock on business software, for example, around the world. Those shares sliding 11%. Let's get more from Rishi Jaluria, IT equity research analyst at RBC Capital Markets. Rishi, thanks very much for joining us. Why do you think investors are displeased with Microsoft today?
Yeah, no, thanks so much for having me. Look, I think we're in a very fickle market. I think we took a step back. This was a solid earnings report. If you had told me that, Microsoft would be trading at 22 times GAAP earnings and maybe lower than that with today's pullback and put up a quarter like this, I would have thought the stock would be up. Now, I think there's two things that maybe are weighing on investors here. Number one, the Azure growth in the quarter was, I thought, solid, but maybe it was a little bit light of what people expected, and it did show a point of decel. Now, they remain capacity constrained, and they definitely signaled that overall Azure growth would have been meaningfully higher if they were actually at parity. And then the second thing is now they're talking about raising CapEx, right? Because, well, how do you get out of being capacity constrained? You have to build more. And so the CapEx numbers are going higher. And I think as we've seen in this market, investors don't particularly care for that mismatch between we have to invest now and the revenue will take time to actually be generated. But I candidly think this is creating a good buying opportunity for us.
It's really amazing. I mean, Azure posting a 38% revenue increase during the quarter. Investors really are looking for exponential increases here, aren't they, in business?
I think that's right. I think with everything going on AI and all the spending, investors are looking for accelerating growth. And in this environment, let's take a step back. That's $9 billion of Azure ARR added sequentially. That is a really high number, especially when you're capacity constrained. But I think in this sort of market, it just tends to be very one number or very short-term focused. And again, I think for those of us that are willing to be long-term investors and think through the long-term TAM opportunities, you can look through the noise and there's a lot more to like in the earnings report.
They are pretty involved with OpenAI. Is that a worry? Because there's been concerns about OpenAI's debt and heavy spending, for example.
Yeah, look, I think there's two pieces here that I think are really important. So number one is they did tell us in a new disclosure that OpenAI represents about 45% of commercial RPO, and RPO being kind of a good measure for future backlog, future revenue to be recognized. But they also are not including all of OpenAI in there. They're effectively saying, look, we're risk adjusting this, and the longer the duration, the more kind of risk adjustments they're making. So I think they're being pretty conservative with what they are including in that backlog number. Well, the second thing, which I don't think is super well understood by the market, is all of these applications that, by the way, they're showing some really good signs of early traction with, be it Office Copilot, GitHub Copilot, Security Copilot, Dynamics, et cetera. All of these AI applications are built in a modular manner that is not entirely dependent on OpenAI. In fact, you can use Anthropic models under the hood. You can use open source models, be it Llama or Mistral. And so as a result of that, Microsoft's fortunes are not entirely dependent on OpenAI. Obviously, they have kind of a good situation with OpenAI where they have research rights till 2028, IP rights till 2032, exclusivity of the OpenAI API. But their future fortunes are not dependent on OpenAI. That if OpenAI doesn't quite do as well, and by the way, with all the noise around the model provider, they're still one of the cutting edge frontier model providers along with Anthropic and Google. But if they really just don't go to the level that I think people want them to, Microsoft can still succeed.
Essentially, I'm not sure if you saw this story. I think it's only Forbes are reporting it right now. OpenAI is supposed to be working on a new social network that will only allow people on board using biometric identification. Bots can't get in on the act.
Yeah, no, look, it's interesting stuff. I think one thing that maybe differentiates OpenAI as a company is they're making a lot of very big bets in every area, right? They are not only a model provider. They're trying to build, domain-specific agents. They're getting into healthcare. They're talking about consumer applications. Now you have, social media. There's, they're talking about getting into the advertising game. They're making a lot of very, very, very big bets. And, candidly, if this is a company that aspires to be the largest company it can be, you need to make all those big bets. Some of them may pay off. Some of them may not. Some of them may have mixed success. In many ways, it kind of reminds me of Microsoft, right? Like, Microsoft did get into social media. They bought LinkedIn and they made LinkedIn a much bigger asset than it could have been. They're obviously huge in enterprise software. They're in infrastructure. They're in security. They're in developers. They're in gaming. They're in search, right? I mean, very few of us use Bing, but it's actually a huge, huge business. So, it kind of reminds me of that in a certain way. And, look, I think it brings up a good point that as we have to figure out how do we differentiate what is actually AI versus what is human, and that line is getting blurrier and blurrier by the day. Ways of having verified content, verified actors, I think will become increasingly important.
And you would be a buyer of Meta right now, of Microsoft, I beg your pardon, and your target $640 US?
I think so. Look, I think I would take huge advantage of this pullback. The market seems like it's being candidly pretty irrational on Microsoft right now. Lots to like out of the quarter, strong Azure number. And again, they're being, I think, conservative with a lot of their stuff. And then you saw really good success out of Microsoft Fabric, hitting $2 billion of ARR less than 2 years after being introduced onto the market. Good signs of early traction with M365 Copilot. GitHub Copilot remains strong. I think there's a lot to like here. By the way, they're preserving margins in spite of all of this spending. And to get that at 22 times GAAP earnings, this candidly seems like a gift to me.
Thank you very much, Rishi. Really appreciate it. Rishi Jaluria, IT Equity Research Analyst at RBC Capital Markets. Time for hot picks in gaming and gambling. Our guest has DraftKings as his top pick, and he says the company's expansion into predictions has created some uncertainty for near-term profit, but investors are willing to hold the stock for more than a few months, could be in for a good opportunity. We're joined by Jason Tilchen, Senior Research Analyst in Digital Gaming and Entertainment at Canaccord Genuity. Thanks very much indeed for joining us. Just remind us now, DraftKings, we know, is a dominant player in sport betting. So they're getting into this predictions industry. Can you remind us what that will involve, please?
Yeah, absolutely. Thanks for having me on. DraftKings is really a pure play North American digital gaming operator, and growth over the past few years has been driven by an increasing percentage of the U.S. population with access to online gambling through state-by-state legalization, and increasing monetization of those users through product innovation. The key debate at the moment, as you mentioned, surrounding the stock, is the impact that prediction markets are having on the regulated sports betting industry. The short version is that prediction markets, which initially gained popularity during the 2024 presidential election, really started to take off last year when they started to introduce sports contracts. And they really saw a spike of trading activity on these platforms during this past football season, particularly in states where sports betting is not yet legal. They're really able to do this by claiming these contracts are federally regulated swaps exempt from state gaming laws. And the reality is the matter is likely not going to be settled from a legal perspective for years, could end up going all the way to Supreme Court. So as it relates to DraftKings, there's two issues for the stock today. First is the level of investment they're making in their own prediction app, which they launched at the end of last year, and the impact that's going to have on 2026 margins. And then the second is based on the latest state data. There's been a bit of a slowdown in engagement across the industry. There could be a variety of factors that play into that, particularly over a short period of time. But there's a concern from some investors that these prediction markets may be starting to have a little bit of a cannibalization impact on regulated platforms. So the combination of those two things has really pressured sentiment around this stock. And while we do expect shares to remain volatile until the company provides 2026 guidance in a few weeks, I think the sell-off ultimately has created a very attractive valuation for a business we forecast is still going to roughly double its EBITDA to around $1 billion this year, even after those prediction-related investments, with additional top-line growth and margin expansion going forward.
And sorry, we're really tight for time, but will this move into prediction markets alienate sports partners, the sports leagues, if DraftKings does that?
So I don't think it's necessarily going to alienate them. They've definitely taken a cautious approach. Each league has taken a different approach to this as well. The NHL and MLS are two leagues that have actually partnered with prediction markets. Others, like the NFL, are taking a little bit more of an arm's length approach for now as this emerging industry develops. But definitely they take all stakeholders and put them in mind when they're making these decisions around product innovation.
It really is amazing, the boom in gambling around the world. Flutter Entertainment, FLUT in New York, what do they do?
Yeah, it's actually a pretty similar business to DraftKings, but in addition to having one of those leading platforms in North America by market share, which is FanDuel, they also have a portfolio of online and omni-channel gaming brands around the world. So a little over 40% of their total revenue today comes from North America, the balance from international markets. But their strategy has really been to acquire a local brand that has a podium or near podium position in attractive growth markets, and then to sort of pour gasoline on those businesses by taking best practices developed over the past 2 decades around the world and applying those to drive share gains and operating efficiencies. Same game parlays is a very, very good example of this. That was initially developed by Flutter in Australia back in 2016, and they've brought that to the US and other markets, and allows them to really generate more revenue per dollar wagered relative to other companies. They can reinvest that back in promotions and product development, and sort of it's a pretty virtuous flywheel that's been driving really strong retention and engagement for them over their entire global operating footprint. But in addition to those prediction market dynamics that we just mentioned in the U.S. market related to DraftKings, they've also been facing some tax increases in other markets like the U.K. But the good news is that we think all of this has sort of been more than priced in at this point, with the stock down over 20% so far this year, nearly 50% off highs from last summer. This is a really quality, diverse business with great management team. And for investors, as you mentioned, with a longer time horizon, I think this is definitely a very attractive entry point, trading at less than 12 times consensus 2026 EBITDA.
And finally, Sport Radar, SRAD. Why do you think this one offers promise?
Yeah, this is a pretty unique business. It's more of a picks and shovels play on the global online sports betting market. So they're one of the leading data providers to sports betting and media companies. They sit really between the leagues, who they pay for the exclusive right to collect and distribute their official data, and the sports books and media companies who use this data. And it's really, especially for the sports books, a mission critical product. The larger books like DraftKings and FanDuel, they need this low latency data feed that Sportradar provides for their in-house pricing teams. And then there's a variety of hundreds and hundreds of mid-sized and smaller sportsbook operators around the world, and they offer a variety of additional services, managed trading services and odds feeds to those companies as well. And in addition to sort of the organic growth that they continue to experience due to the global market expanding, margins should continue to increase roughly 1 to 3 percentage points annually. That's because they've just completed sort of the latest renewal cycle for most of their key sports properties, so there should be limited growth in what is their largest expense, and then allow them to sort of develop new products to enhance monetization of those rights and drive operating leverage over the next few years. So the stocks really had a sharp sell-off due to the sentiment across the sector, but they're mostly unaffected by these issues that have been challenging the B2C operators, and we think unfairly punished as a result, which again only creates a pretty attractive opportunity for investors.
Jason, thanks very much indeed. You covered a lot of ground there. Thanks on this industry that's just exploding. Really appreciate it. Jason Tilchin, Senior Research Analyst in Digital Gaming and Entertainment at Canaccord. Coming up, MasterCard shares up after the company posted a profit beat. We've got our eyes on MasterCard right now. Profit from that giant card supplier beat in the latest quarter. The shares edging up 2%. Apparently, spending is holding up on travel, leisure, and also everyday essentials. Let's get more from Harshita Rawat, Senior Research Analyst at AB Bernstein. Thanks very much for joining us.
Thanks for having me.
Just walk us through the quarter briefly, if you would. What jumped out for you with this report from MasterCard?
Yeah, absolutely. It was a very strong quarter. Overall, consumer spending has remained steady despite all of the concerns. MasterCard beat earnings by 10%, more than 10%. Some of that was one-off dynamics. But again, I think the guidance for 2026, which was a key area that investors were watching, was also quite strong at 12 to 13%. And then MasterCard is doing extraordinarily well in terms of growing beyond payment and networks into value-added services, which have grown north of 20%. So overall, steady spending, good momentum in value-added services, and also, strong outlook for 2026.
That's interesting. They're diversifying beyond just the traditional card business. Can you give us one or two examples?
Yeah, I mean, 2/3 of their value-added services are card-linked, but then there is a strong and growing attach rate of things around cybersecurity, data and personalization services, analytics. And that business this quarter grew north of 20%. So if you think about their overall switched volumes kind of growing 9% in the quarter, and then you have this value-added services, which is now approaching significantly north of 40% of their revenues, kind of growing 20%. That adds to the incrementality of revenue growth, which is why we saw yet another very strong revenue growth quarter from MasterCard, and they're guiding to 12 to 13% revenue growth in 2026.
I'm just comparing MasterCard and Visa over the past 5 years on my Bloomberg screen. Pretty similar total return, a bit more than 70% over 5 years. But both have lagged the S&P 500 financial index. They've been flagging a little bit lately. Why is that?
Yeah, no, that's such an important question. And I think there's a combination of factors, right? More recently, there is this growing regulatory noise and scrutiny, and happy to talk more about that. You've seen some of the activity in the US. Then there is this kind of funding for the AI trade. Visa and MasterCard used to be in the TMT index. They moved over to financials. So they went from kind of cheap TMT stocks to expensive financials, and there was rotation within financials. But then if you kind of look at their underlying growth and the underlying numbers, they've been rock solid. So here we are, MasterCard trading at the bottom first percentile relative valuation range in its last 10-year history because of some of these factors, but fundamentals remain very strong.
What about President Trump's I could say he's just floated this idea of capping interest rates on credit cards. Obviously, the financial industry, the banks weren't happy about that. Is that a real threat?
Yeah, I think it's interesting, right? Like, I think the first social media post came around 2 weeks ago. And then last week, President Trump essentially said that he's going to ask Congress to draft a bill capping 10% credit card interest rates. We thought that was a more benign outcome because, once it goes into the legislative process, there's a lot of debate. The likelihood of passage at this point feels a little bit low. And that said, though, I think the broader, agenda here is the affordability crisis and asking banks and payment companies to kind of, help on the affordability crisis. So I think we will see banks, and I think we've seen some news announcements of this already, looking at this 10% interest rate capped credit cards, which is, I think, not that dramatically different from some of the introductory 0% APRs that banks have on new credit cards. But at this point, the likelihood of any legislation on credit card interest rates feels low.
Harshita, thank you very much indeed. Really appreciate it. And you have, I see, an outperform rating and a price target of $710 US. Really appreciate it. Harshita Rawat has been our guest there, Senior Research Analyst at AB Bernstein. Now, we could go on talking to you all day, but got to make room for Roger Peterson here. We've got to leave you on the open, but morning markets, the real action is coming up next.